It wasn't a sudden supply shock. It wasn't a speculative mania driven by retail traders. It wasn't even a geopolitical anomaly. It was the mathematical inevitability of currency debasement. The pattern is unmistakable. History does not merely rhyme. It repeats with merciless arithmetic. When an empire reaches the limit of its credit card, when the promises made to the future exceed the resources of the present, the relationship between gold and silver tells the story. We are not looking at charts. We are looking at the behavior of human beings under monetary stress. The data is clear. We will examine 3 specific historical case studies. We will map the ratio, and we will see exactly where the metals stand for the years ahead. Look at the Roman Empire. Specifically, the reign of Nero around 64 AD peak dominance. But the costs of empire were unsustainable. The legions required payment. The bureaucracy required funding. Nero chose the monetary shortcut. He reduced the silver purity of the denarius. He thought the market wouldn't notice. But the market always knows. Inflation arrived. Not immediately, but inevitably. A Roman centurion, once paid in sound silver, suddenly found his wages buying half the wheat. The middle class was priced out of land. Wealth fled into tangible assets. The silver content dropped until the currency collapsed entirely in the crisis of the 3rd century. Just like Rome, the pattern re-emerged in the 20th century. Consider Weimar Germany. The year is 1923. The war debts were unpayable. The industrial base was crippled. The government chose the printing press. The result was not linear. It was exponential. Gold became unobtainable for the common man. Silver became the desperate hedge for the working class, a simple clerk, watching the mark depreciate by the hour, rushed to convert paper into anything metallic, silver cutlery, scrap jewelry, anything that held value, while the wealthy secured gold abroad. The internal economy collapsed into a barter system based on hard assets. Social fracture was total. Just like Weimar, the British Empire faced its own reckoning. Look at the decline of the British pound. From 1914 through the 1970s, to world wars drained the treasury. The gold standard was abandoned. The incentive was to inflate away the war debt. The pound, once as good as gold, lost over 90% of its purchasing power. The British saver saw a century of accumulated wealth evaporate. During the crises of the 1970s, gold soared, but silver moved with even greater violence. The volatility was the price of admission for preserving purchasing power. The pattern repeats in 7 distinct stages. Stage 1 is the era of sound money, where gold and silver act as the foundation of trade. Stage 2 is the expansion of credit and imperial overreach, where promises exceed the ability to pay. Stage 3 is the removal of the hard peg, allowing the currency to float on faith alone. Stage 4 is the acceleration of deficits, funded by the central bank. Stage 5 is the onset of persistent inflation, which authorities initially dismiss as transitory. Stage 6 is the flight to safety, where capital abandons government bonds for gold and eventually the more volatile silver. Stage 7 is the reset, where the currency is either revalued against metal or replaced entirely. Just like the decline of the sterling, we are currently navigating the transition between Stage 5 and Stage 6. The data is unambiguous. Central banks are buying gold at a pace not seen since 1967. They are securing the Tier 1 asset. They are hedging their own liabilities. This is the behavior of the insider. But silver tells a different story. Silver is the industrial metal, the strategic asset, and the monetary refuge for the rest of the population. Current data suggest a structural deficit in silver supply, driven by green energy mandates and stagnant mining output. The gold-to-silver ratio currently sits at historically high levels, implying that silver is cheap relative to gold. When the public finally moves to protect their purchasing power, they cannot afford gold bars. They buy silver. This is why, in the late stages of a currency cycle, silver often outperforms gold in percentage terms, catching up with violent speed. Some economic historians note that in a high-interest rate environment, non-yielding assets like metals should struggle. That is the standard counterargument. But the arithmetic is merciless. When the interest on the debt exceeds the revenue of the state, rates become irrelevant because the currency itself is the risk. The incentive is to devalue the liabilities. Under these constraints, the rational move is to hold the asset that is no one else's liability. We face three potential endgames. First is a controlled decline. This is financial repression. Inflation runs slightly hotter than interest rates for a decade. Gold grinds higher, preserving wealth. Silver remains volatile but trends upward as industrial demand squeezes supply. We saw this in the post-WWII period, roughly 1945 to 1955. Second is a chaotic collapse. Confidence in sovereign debt evaporates suddenly, yields spike. The central bank is forced to print everything to save the bond market. In this scenario, gold is the shield, but silver is the spear. The gold-to-silver ratio collapses as the public rushes into the more affordable metal. This mirrors the late 1970s. Third is a reset and restructure, a return to a commodity-backed system, or a digital currency pegged to a basket of hard assets. In this scenario, gold is revalued to balance the global balance sheet. Silver rides its coattails. This happened in 1930 under Roosevelt. The only variable is timing and pain. Subscribe for more analysis on historical cycles. Build resilience. Study the data.